Ladies and gentlemen, good day and welcome to Akums Drugs and Pharmaceuticals Limited Q1 FY25 earnings conference call hosted by Ambit Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prashant Nair from Ambit Capital. Thank you, and over to you, sir.
Thank you. Hello, everyone. On behalf of Ambit Capital, I welcome you to the 1Q FY25 earnings call of Akums Drugs and Pharmaceuticals Limited. We have the Akums management team with us, represented by Mr. Sanjeev Jain, Managing Director, Mr. Sandeep Jain, Managing Director, Mr. Sumit Sood, CFO, and Mr. Sahil Maheshwari, General Manager, Strategy. I now hand over the call to management for opening remarks, following which we can get into a Q&A session. Over to the management.
Thank you, Prashant, for the introduction. Good evening, everyone, and welcome to our Q1 earnings call. I'm Sahil, General Manager for Strategy. Let me draw your attention to the fact that on this call, our discussion might include certain forward-looking statements, which are predictions, or other estimates about future events. These estimates reflect management's current expectation of the future performance of the company. Please note that these estimates involve several risks and uncertainties that could cause our actual results to differ materially from what is expressed or implied. Akums does not undertake any obligation to publicly update any forward-looking statements, whether as a result of new confirmation, future events, or otherwise. I hope you have gone through the investor presentation and the results that were posted. I would like to request Sandeep Jain, Managing Director of the company, to please take it forward.
Thank you, Sahilji. Namaskar, everyone, and thanks for joining us on this call. Since it's our first conference call post-listing, I will take a few minutes to deep dive on how the business is structured and also articulate on growth levers of our business. Akums is the largest India-focused pharmaceutical CDMO with over 30% market share. This is the main business vertical of the group, contributing to over three-fourths of the total revenues. Our company caters to 1,500 plus clients annually with long-standing relationship with top pharmaceutical companies in India. We cater to both Indian and MNC pharma companies with 26 out of top 30 in India pharma market being our partners. As a CDMO, we produce an extensive range of dosage forms including tablets, capsules, liquid orals, vials, ampoules, topical preparations, eye drops, dry powder injections, nasal sprays, amongst others. Since our inception in 2004, we have commercialized over 4,000 formulations across over 60 plus dosage forms. We have 11 units operational for formulation CDMO business with capacity of over 49 billion units annually. Some of our manufacturing units have been accredited by various global regulatory agencies, including European GMP, WHO GMP, USF, NSF, etc. We also operate 4 R&D centers with over 400 scientists working over there, with around 2.6% of our revenues being invested in R&D. We are continuously building and R&D capabilities in pipeline. In Q1 itself, we spent over 30 crores of INR in R&D. We are leading players in India holding 940 plus DCGI, including 20 DCGI added in Q1 itself, and 920 plus FSSAI approvals, showcasing our extensive strength in formulation development. We are passionately working towards strengthening our leadership position in CDMO space in India by expanding capacities to cater to a growing CDMO market, extending capabilities to newer dosage forms, and developing robust portfolio of innovative formulations. In India, with our strategy, we recently started our new injectable facility with an annual capacity of around 36 crores units. The unit is currently undergoing customer audits and is expected to ramp up in next 24 months. Also, we plan to expand in Jammu to augment our capacities. Our plan is to set up 2 units over there. One is multi-dosage facility and another is a nutraceutical facility. We have recently ventured into new dosage forms, including nasal sprays, gummies, and soon will start commercialization of lyophilized injections as well. In addition to our core CDMO business, we actively engage in marketing our own branded formulations in India and across global markets. Through Akumentis, we focus on therapy areas such as gynecology, cardiology, orthopedics, and pediatrics in India, with around 70% sales in chronic and subspace therapy.
Sorry to interrupt, sir. Your voice is breaking. Sir, can you hear me?
So I think the line. So I continue forward. So we have almost, as Sandeep sir was mentioning, we have almost 70% plus sale in chronic and subchronic therapies. Leveraging our strong field force of over 1,500 employees, we market over 140 brands. Further, through UnoSource, we focus on global markets and currently present in 65 countries across multiple therapies, including CNS, anti-infectives, analgesics, gynecology, etc. We currently hold 700 plus dossiers globally. And in Q1 itself, I'm happy to share that we received 75 additional approvals for the dossiers. And we are actively expanding our team in various markets to capture global demand for quality generic products. We also engage in the marketing of trade generic products through distributors across India. Apart from these two business verticals, we are also present in API business, which contributes to over 5% of our revenues. We have an installed API manufacturing capacity of 737 metric tons, and currently almost 85% of the sale comes from cephalosporin APIs. We also manufacture APIs in respiratory, gastro, CNS, and anti-diabetic therapies. The business was recently started and is currently under ramp-up phase. We are strengthening our capabilities in R&D, manufacturing, and customer reach to scale up this business. Finally, as Akums, we are glad to introduce Mr. Amrut Medekar, who has recently joined us as CDMO for CDMO operations. Mr. Medekar brings with him almost 25 years of experience in pharma space. Now, let me hand it over to Mr. Sumit Sood, who is the Chief Financial Officer for the group.
Thank you, Sahil. I'll take you through the group and the segment financials. If you see our results, the consolidated revenue for the group had increased from 970 crores to 1,019 crores during this quarter, the growth of almost 5.1%. Consolidated adjusted EBITDA grew from 108 crores to 131 crores, a movement from 11 to 12.7%. Consolidated adjusted PAT margins improved from 38 crores to 57 crores. There was a movement of 3.9 to 5.6% in the PAT. Consolidated gross margins also saw an improvement from 376 crores to 423 crores. It moved from 38.8% to 41.5%. If we now look at the segment, so if I take the CDMO first, the CDMO grew from 740 crores to 782 crores, a growth of 5.6%, largely driven by volume growth of 14% compared to Q1 24. It's pertinent to mention that the pharma industry had a flattish volume growth during this period. The moderation of the revenue growth compared to the volumes was due to softening of the API prices. Our business is based on cost plus margin. API prices impact our realization from our clients. If we look at the CDMO EBITDA, it improved from 107 crores to 121 crores. There's a movement of 14.4% to 15.5%. The branded generic revenue reduced from 191 crores to 167 crores. This is a 12.5% reduction. Efforts to consolidate the trade generic business and continued performance of the branded and generic formulation business has led to the improvement of EBITDA from 7 crores to 17 crores. So the EBITDA moved from 3.9% to 10.2%. API revenue improved from 38 crores to 70 crores, a growth of almost 82%. Exports in the API division have increased from 3 crores to 9 crores in Q1 25. The API prices, though, had an impact on the margins of API business, wherein the COGS percentage increased due to fall in revenue realization. The EBITDA moved from 9 crores to minus 12 crores, from minus 9 crores to minus 12 crores. The EBITDA margin sort of improved from negative 23 to negative 17.4%. The company was able to reduce its debt by 205 crores from 418 crores to 213 crores for Q1 25. Cash flows from operations, we were at 52 crores positive, and the free cash flows were 31 crores positive. The working capital improved from 1,084 crores to 881 crores in the first quarter for the group. We sort of released a total of 203 crores in the working capital. So these are the financial results from our side. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, to ask a question, you may press star and 1. Ladies and gentlemen, to ask a question, you may press star and 1 on your touchtone phone. First question is from the line of Ashish Thakkar from JM Mutual Fund. Please go ahead.
Yeah, thanks for the opportunity. So on the branded and generic formulation business, you did mention that, you are trying to cut the losses and therefore revenues are slower. How should we look at this business going forward? Is the loss-cutting activity over, or there's still some time to go?
Sure. So let me address Ashish. So essentially, the branded and generic formulations is segmented further into 3 categories. One is the domestic branded segment, the second is the exports, and the third is the trade generic. Right. As we said, we are curtailing losses. It is only to the trade generic segment, while both the branded domestic, the prescription branded domestic, as well as the exports, both are positive. So in a way, the movement was earlier also positive. So overall in Q1, as Sumit ji earlier mentioned, was from 3.9%, we moved to 10.2%, right? And to your point, yes, we are in a process to further curtail down these losses into the trade generic segment.
But then how should we look at this business growth? Because this is there a trade-off between improving margins and the revenues? How should we look at it?
Sure. So as I said, both the branded businesses, which are of key businesses, and they both have EBITDA margins above the corporate margins, right? So both of them are healthy, growing at a healthy pace, and we continue to stay active on these 2 fronts. Regarding trade generics, we had opportunity to consolidate this business. So that is there where we are consolidating the revenue, and the trade-off is largely over. From now on, what we feel is the worst is in a way behind us, and we should see some further improvements in the overall margins for the branded and generic formulations.
Okay, that's good to hear. So my second question is on this the parabolic drugs that the losses were there last year, and so how should we look at the losses coming down? Is whatever restructuring that we were trying to do at their facilities, are all those activities over, and when can we see some contribution coming from parabolic?
Sure. So the parabolic, which today sits in our subsidiary Pure and Cure, which we acquired. So, rightly so. So if you really look at the trajectory of Parabolic in FY23, we had almost a 50% EBITDA loss. Then last year, we almost had a 40 crore plus EBITDA loss over a sale of roughly 210 odd crores. So largely the EBITDA is improving. Now, if you really look at Q1 to Q1, last year we had almost minus 23% of EBITDA loss, which now has improved to minus 17%. Right. While the progress in improvement is a bit slow in this quarter, essentially which is driven by the prices softened for the cephalosporin. So as I mentioned earlier as well, cephalosporins was almost 85% of the business. So the prices fall. So while the realizations fall, the COGS percent it moved up. But in a way, the other aspects of the business, they stay intact. The growth is positive. As I'm happy to share, even in the first quarter, we also exported to Spain from our Dera-Bassi facility. Right. So we continue to add more countries, more accounts, more customer base, and see how can we expand this business going forward. So all the growth levers are intact. While if you really look at it, the percent profitability also improved Q1 to Q1.
And so before I get into the queue, as far as the potential in the parabolic drugs is concerned, can we go to 1,000 crore revenue mark, so which it used to do in earlier days? Is that kind of a potential still there in the parabolic asset?
So I think you have read the financials of Parabolic, which was also a listed entity. So the assets are largely the same, right? So it is Dera-Bassi, Lalzo and assets. These assets are fine. It used to do approximately a decade back that kind of revenues. But a pertinent point I wish to make over there is also it was approved by global authorities, right? So that endeavor is there that we in coming years export to more countries. But as far as your question is concerned, obviously that facility is currently having significant space for revenue expansion.
And when do you see this facility becoming EBITDA neutral? Are there any timelines?
So as in this point, I cannot put down a quarter wherein we would, but the results are encouraging. As I was mentioning earlier, year on year, if you look, or even quarter on quarter, the percent decline is coming down. The revenues are increasing. The customer base is increasing. We have an active product pipeline commercial which is there. So the efforts are into the right direction, and I feel that we should be in a good business. In this business, we should be able to do a good business.
Thanks. I'll get back in the queue.
Thank you.
Thank you. Before we move to the next question, a reminder to the participants to ask a question. You may press star and 1. Next question is from the line of Rahul Salvi from Franklin Templeton. Please go ahead.
Yeah, am I audible?
Yes, please go ahead.
Yeah.
Yes.
Yeah. So I had a question on the CDMO business. So the thesis here was basically that this business can grow faster than the Indian pharmaceutical market, basically by volume share gains as well as gains in private labels, trade generics, etc. So that will also drive volume. But this quarter, I think the volume growth was just 6% or 5.6%. So if you could speak whether how we should expect this growth over the full year period, and whether that trajectory of a low double-digit to mid-teen kind of a growth in this business is intact.
Right. So just a correction on to your question first. So as volume, as I mentioned, we grew more than 13%, almost 14% we grew into volume terms. The revenue growth was 5.9%. So volume, yes, we grew faster. If you really look at the market, the volume and the new introductions, these were largely flattish in low single digits, if you really look at the math. But we grew double digits, which was almost at a 14%. So the underlying thesis is correct, that we are growing faster than the market, much faster than the market. As was mentioned earlier as well by Sumit, that essentially the business model is a cost-plus model. Right, so the API prices have an impact on the transfer prices or the revenues we realize from our clients. But as I was mentioning, the volume is intact, and as you said, across the therapies, the zones, the clientele we serve, we continue to see a good attraction to our business.
So if the volume growth was 13%-14% and the revenue growth is 6%, so that means the product mix was inferior towards low price product. Is that how we should read it?
No. So yeah, the product mix remained the same. As I mentioned, the API prices this quarter, they fell almost by 7 to 12%, depending on the API therapy, right? So once your API prices fall down, the revenue realizations fall down.
Got it.
Since it's a cost plus model, every purchase order, it's a complete pass through to the customers, whether it's a inflationary price or a subdued price of the API.
Okay, got it. And what has led to the improvement in gross margins of around 430 basis points in this quarter, YOY?
Sure. So as we were mentioning earlier, so we received multiple new innovative approvals, the new DCJ approvals, right? So we also had good operationalization of our facilities, right? If you really observe, the utilization levels also improved, right? So it helps us improve the overall gross margins.
Okay. And on the full year
product mix in a way, yeah.
Yeah, and on the full year basis, how should we expect the revenue growth trajectory? So since the API prices are stable and say at those lower levels, so will the full year growth will also be slower on the CDMO side in terms of reported growth, even though the volume growth might be higher?
So honestly, sitting today, we cannot predict the API prices, right? While still the sum of the API prices have bottomed out, there is still a good chunk of API prices which still continue to see a downward trajectory. Having said that, the key business growth driver for us is profitability and the volumes, right? Those two remain strong. If you really look at it, the EBITDA margins also improved and the percent margins also improved, as well as the volume growth was strong. Right. So as and when the API prices corrects, it's right, we'll see an uptick in revenue, but sitting today, it's difficult to comment what will be the revenue growth.
Okay. And on the branded and generic formulations business, so if you could split out between the three segments, Acumentis, trade generics, and the third segment, as to what is the revenue split as well as margin split for us to get a better clarity in terms of trajectory. So if you could put that in the presentation itself, is that a possibility in the near future?
So,
yeah, so, Rahul, the issue we have is that we don't give that split in the financials, right? While we've grossly told you that there is an overall very healthy growth in the EBITDA margins from 7 crores to 17 crores, but we would be under compulsion not to probably disclose something which is not in the public domain. So we'll apologize for not letting not give an answer to your question.
Because the challenge we face is that these three are completely different businesses having different business models and drivers. So it becomes easier for us to track the performance over a long period of time. That was my submission. So I will fall back in the queue. Thank you.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1. Next question is from the line of Christy Orr from HSBC Asset Management. Please go ahead.
Hi, thank you for the opportunity. So I just have one question on the cost plus model on the CDMO side. Because we're also aware that the API pricing downward trend has been happening since the end of 2022. And despite that, throughout 2023, I think our performance in CDMO actually did quite well, close to 20% growth, if I remember correctly. So has anything changed ever since? Because if the API pricing trend hasn't really changed and it's actually been improving, yet our performance is actually probably slightly lower compared to last year. Is that due to potential outsourcing rates going down, or is there something else that might be driving that pricing gap? Thank you.
Sure. So as I said, I'll bring all the points together. First is the volume growth was intact, right? Almost over 14%, right? The margins, they improved, right? So what fell down to realization is the factor that the API prices went down. Right. So there was a consistent supply from both the Indian as well as the global players. Then there was stabilization in the prices of the solvents and the KSM prices, right? Due to weakened demand in the overall pharma industry, while we grew in the volume terms, the overall pharma industry was largely flattish. So all of these factors led to release of inventory from the API players, right? And hence the API prices in others fell down. While 22, as you were mentioning, was a period of high, but then there have been since then several API cycles of plus and minus. So that's there, right? Yeah, I hope I've addressed your query.
Yeah, I understand the inventory release part, but would you mind clarifying again on what might be the difference compared to last year?
Sorry, what might be?
What might be the difference in terms of the price deceleration compared to last year? Because I suppose when inventory destocking that happened last year, when China was dumping a lot of API excess capacity to us in India, that has led to a very steep API downward pricing trend. And as we stabilize right now, if anything, it should not be worse than last year. But despite the downward pricing trend last year, we delivered 20% growth. So I'm just wondering what else might be causing the price discrepancy between this year and last year.
So no pardon, as I mentioned, so the supply, the calming down of the solvent, the KSM prices, as I mentioned earlier, there was almost a reduction from 7 to 12% in the API prices. Few of the APIs, for example, cephalosporins, paracetamol, they continue to see a downward trajectory. So there's still softening of few of the APIs.
Okay, got you. Thank you. I'll turn back in the queue.
Thank you. Participants, to ask a question, you may press star and 1. Ladies and gentlemen, anyone who wishes to ask a question may press star and 1. Next follow-up question is from the line of Ashish Thakkar from JM Mutual Fund. Please go ahead.
Yeah, thanks for the opportunity again. So given that this is the first call after your listing, and on an overall basis, would you like to guide to the investors for FY25? How should we look at the next 3 quarters panning out? Because the first quarter was of just a 5% revenue growth, while there was margin improvement. Would you like to give some color or some assistance from your side?
So Ashish, essentially, so as I was mentioning, there have been a good traction to the business. The volume is growing, the margins they remain strong. We have been performing well. So the endeavor is how can we perform well. As of today, we cannot give any guidance for the year, but all the levers, for example, the losses the trade generate, they continue to curtail. The API, there's a good amount of effort which is done to minimize the losses, and as and when the cephalosporin prices they average out from the current bottom, we might see an uptake in the revenues, right? The export business is going strong. We have good product mix today, which has led to improvement of our gross margins, right? So all of these factors, we believe the business should grow and do well, but as of today, we do not wish to give out any specific guidance.
Is there a seasonality in your business in terms of the quarters?
So limited seasonality, but you might win some good orders at times. So some quarters you might win some good quarters, and then there are opportunities which lie with, for example, if I get a regulatory approval in Q3, Q4, that might pan out well if it's a good product in demand, right? And then there might be some new customers which we add, which bring in revenues which get shifted from other CDMOs. New companies launching new divisions that might give us a boost. So while the pharma, if you really observe Q2, Q3 are strong quarters, then get driven by monsoon season, and then the winter season. But for us, largely, it is good. But we have in the past really seen that some of the quarters might perform well, driven by what our business wins are.
Okay, fair enough. And anything on the recent Optal facility which you commercialized, would that contribution start from quarter 2 onwards or quarter 3 onwards?
So the new injectable facility which we commercialized starting 22nd this month. So how this happens is you need some time to get